What's happening, traders? What's good? It's a remark out here, and I'm so excited to bring you the CTC mentorship course. And this has been a long one. Last year was really good for us, and we've been able to do a whole lot of things. These videos are just going to be more like the advanced price action study. So let's just move ahead. Today we'll be studying IPDA. That's Interbank Price Delivery Algorithm. I know a whole lot of you have heard about IPDA. You'll be seeing people writing IPDA, but you don't know what IPDA is. On this lesson, I'm going to break down in simplified terms what IPDA is. Remember, in the CTC, we are only here to simplify ICT's concept. We are not here to change its concepts. We are only here to simplify it for the layman. We are only here to simplify it for people that are like me, that don't want to go into the deep things and the whole trying to figure out the whole enigma mystery behind ICT's concept. We're just trying to keep it simple because that's what Forex trading is all about. So let's dive deep to the class. Now, before you talk about IPDA, you need to understand what an algorithm is. Algorithm will be the first thing that we are gonna put into explanation before diving deeper into what IPDA is. So what is an algorithm? An algorithm is a set of well-defined structures built in to solve a particular problem. Let's move a step further before I come in to explain what this is. Let's look at another definition of an algorithm. An algorithm is a finite set of instructions carried out in a specific order to perform a particular task. Now, to the final explanation of what an algorithm is. It's a process or a set of rules to be followed in calculations or other problem-solving operations, especially by a computer. So if you are a computer student or if you're a computer science student already, you would have known what an algorithm is. So for those of us that didn't literally study computer science, here we are dealing with computer science issues. So this explanation is basically for us. For those of you that basically don't know what an algorithm is, so this is basically explaining the whole thing for you. The main thing here is, the main pick-up point is, an algorithm is a set of well-defined instructions. That's the first explanation. The second explanation says it's a finite set of instructions, which is basically like the same thing, a well-defined instruction. The third one says it's a process or set of rules. Understanding this in a layman term simply means that an algorithm is a program that is being imputed inside the system with a well-defined instruction. You get me? It has a set of rules. It has something it needs to follow in order for it to solve a particular problem or perform a particular task or do a particular thing entirely that is set out by that particular system. Understanding an algorithm, what algorithm is on itself, will help you understand the concept of IPDA. Understanding the concept of algorithm is going to help you know the reasons behind why we say trading is basically based on algorithmic theory. Because in trading, remember, it's a series of rules or a series of instructions. Remember in your entry strategy on the 1.0 course, where I said Forex trading is basically about, if this happens, then this. If A happens, B needs to happen. B happens, then I want to see C happen. It's a finite set of instructions carried out in a specific order. There is a specific order in which you need to see things happen on the chart before you can engage. So that's the concept behind algorithm in Forex. So Forex, you don't just jump in. You need to understand that Forex is based on algorithmic theory. You understand me? So understanding this is very crucial. Now, since we've understood what an algorithm is, let's dive deeper into IPDA. What is IPDA? Now, IPDA is basically a high-tech set of instructions in the market that's programmed to engineer or create liquidity in the market. It does this by creating highs and lows in the marketplace. These areas created by IPDA is where all liquidity resides. Most often, these are areas where beginner traders trust to place their stop loss and pending orders, like buy stops and sell stops. Remember what we said about an algorithm. An algorithm is a set of instructions that is carried out in a specific order to perform a particular task. Now, bringing this concept into IPDA simply means that in the Forex market, there is a high-tech set of instructions in the market that's programmed in a specific order to engineer or create liquidity in the market. That is the task task. Remember, an algorithm is a set of instructions carried out in a specific order to perform a specific task. So what is IPDA's task? IPDA's task and job is to create liquidity in the market. And how does it create liquidity in the market? It follows a high-tech set of instructions. What is this instruction? It does this by creating highs and lows in the marketplace. It's a specific information being coded into the forex market. It's not basically buy and selling pressure that moves the market. It's a code that runs in the market that moves the market. It's a code that has been put in place in the forex market in order to drive the forex market. Now, what is the task that IPDA does? IPDA creates liquidity in the market. The set of instructions given to IPDA by the creators of IPDA is basically to create highs and lows in the market. You need to understand that these areas created by IPDA, which is the old highs and the old lows where retail traders keep their stop loss, is where all the liquidity is held. Remember, in our first course we talked about liquidity, that the market can't operate if there is no liquidity in the market. So for the markets to run, that means liquidity must be created. What is the program coded into the forex market to create liquidity? That is interbank price delivery. Their job is to create liquidity in the market. Now, the algorithm in its programming logic, the way it's programmed, the way they fix things, is based on human emotions, and its job is basically to manipulate price. We can see these manipulations happen around these old highs and these old lows. Now, its job is just to basically go in, create the liquidity. Now, since retail traders don't know the exact place to drop their stop loss, and they are being taught to drop their stop loss on old highs and old lows, you understand me? That's what the 99% of traders do. They drop their stop loss at old highs and old lows. IPDA's job is to basically create similar areas like this, so that when retail traders sees this, they can place their stop loss, and IPDA takes it out, thereby causing liquidity in the market for them to be able to push their large chunks of positions in the market. You understand me? Remember, when the market makers are selling, they want to sell to people that are willing to buy. They really want to sell their positions to willing sellers, and usually there is not enough sellers in the market, and when the sell orders in the market is not enough, that is when IPDA steps in and creates liquidity. Now, as a smart money trader, when you can understand what the algorithm is trying to do, you can predict future price, and this is what ICC's concept is all about. It's about what the algorithm is basically trying to do. It's about what IPDA is basically trying to do. So we are following the footsteps of IPDA. You understand me? You don't fall prey to all those engineered liquidity. You understand that this is an engineered liquidity. So that means your stop loss is not supposed to be there, or that means you will need to wait for the liquidity to be engineered, taken out before you start looking to enter the market. So once you can understand the concept behind IPDA, once you can understand what IPDA is trying to do, that is when you cut your losses short in the market. Get me? Now, the concepts behind IPDA. How does IPDA basically work? Now, IPDA is a tool created by central bank. They control the money. They make use of retail money as liquidity in the market. IPDA's job is to deliver price efficiently to both buyers and sellers in the marketplace. Now, you need to understand that IPDA is being created by the central banks for the central banks. Once you understand that the market was basically created for you to lose money, because if there are no traders losing money in the market can literally flow. If there is no liquidity in the market, if there is no liquidation in the market literally can't flow. You understand me? So IPDA was created by central banks for central banks. You understand me? They created this so that they can generate a whole lot of liquidity, and they do this because they control the money. Since they own the money, it means they can set the price of the money, and price is dictated by IPDA. See, it's not your buying pressure or your selling pressure that moves the market. It's not supply and demand. Not all those things. Basically, it's the central bank that controls the forex market. The central bank controls the forex market. You get me? They are the clearing houses. There are a whole lot of things that you don't know that is going on behind the scenes. Central banks, they are the owner, and they created IPDA. What did they create IPDA to do? To basically make use of retail money as liquidity in the market by creating liquidity pools like previous day highs, previous day lows, equal highs and equal low, double top, double bottoms. They do this by creating these areas in the market so that retail money can flow in, so that they can use that as liquidity to move the market. You need to understand that as a smart money trader, by now you're supposed to understand that retail money is the liquidity. They are looking to seek liquidity. IPDA's job is basically to seek liquidity. They engineer the liquidity, then they wait for the retail money to flow into the market, and boom, they take them out. And that's the whole purpose of what IPDA is. It was simply made and created for the banks, the big funds, and they basically didn't want you to get involved. Understanding this concept makes trading easier to figure out. This is what you need to understand about Forex market. Forex market is too big, and it's too big that we can't fight the central banks. We can't fight the central banks, we can't fight the big banks, we can't fight those guys. You understand? We are just a tiny piece in the market. We are just like pawns on the chessboard. Get me? But that does not mean that pawns on the chessboard, they are not functional. You know, you can still use pawns to even kill a queen on the chessboard, but the strength of a pawn is lesser than the strength of the queen on the chessboard. Our orders can't move or change the direction of the market. The central banks basically control everything. They hold 90% of the money traded in the market. So the best thing you can do as a trader that has little chunks of money that can barely move a pip in the market is to follow up what the algorithm, that's IPDA, is basically going to do. You follow their footprint. That's the good thing in this thing. They don't hide it. The same way you have simple knowledge, simple things out there in the open, there are some people that are ignorant of it. They don't hide it. Fortunately for us, these algorithmic patterns are being left on the chart after it has been delivered, after it has been created by IPDA. It is being left there. But if you are not aware of it, if you don't know about it, you don't know. Remember when you were a retail trader, you didn't know about all these things, even if it was there on the chart, but you were not able to see it. Now that you are aware of it, you follow them once you see it. The problem with retail trader is they don't understand this concept, so they basically can't see them. Now that you're an institutional trader and you understand institutional concepts, once you see these things, you can't unsee them. So far you're studying and you're looking at it almost every time on your chart. Another thing you need to understand that IPDA's job is to deliver price efficiently on the chart. Although the central bank has the capacity to move price, it must be a balanced flow of money to both the buyers and the sellers in the market. It needs to be balanced and it needs to be efficient. That's why you see paper leaders being filled up, and I'm going to talk about that as we are going on. That is how they do it. Because they can move price doesn't really mean they have to manipulate it, tumble it all around. If not, there will be nobody in the market. So they have to balance it out. And that is why you as an institutional trader need to encode it so that you'll be able to know when buy side is going to be balanced and sell side is going to be balanced. You understand me? They do this by moving from liquidity areas to liquidity areas, offsetting price. You understand me? Or go deeper on this. You get me? Now, how does IPDA delivers price? Now, there are times where the central banks can actually reprice the market. They can actually move the market with manual intervention. What do I mean? Like, there is a natural market maker behind the scene where he will push buttons and you literally see this unfold on the charts. How do you see this unfold itself? This unfold itself through black swan events or using news events like NFP, FOMC, CPI. You understand me? And maybe other high impact news, which, by the way, it's just a smoke screen. The main thing has already been done. They are just using the news to cover up the manual push that was already done by the market maker. Before the news comes out, they know what is going to happen. That is manual intervention. It doesn't matter what the news is, whether positive or negative. They have already made up their mind where price is likely going to go. They have made up their mind. You get me? Once you have an insider information and you can trade off that, then fine. But as a developing trader, you don't need to do that. Now, this is the good thing. When you can understand the mind of the market maker, you get me? You can understand what the market makers are trying to do, and you can work it out by certain fundamental knowledge, and most especially the technicals on the chart. You can basically expect where price will most likely go to based on the knowledge that these news drivers are just manipulation events. There are some times as a trader, before NFP, you've done the analysis and you've seen where price is going to go already. This is because of the technical knowledge you have, the institutional technical knowledge you have, the footprint that IPDA has already left behind on the chart. You already know how to work it out. Since we understand that IPDA's job is to deliver price efficiently to both buyers and sellers, that means they have to offer price in both directions. You look at Bitcoin, it's not just going to be buy, but at some point it's going to sell just to make price efficient, balance out price, then continue running up. It's not just going to be buy. Look at Bitcoin, buy, at some point it crashes down just to fill up the fair value gap, just to fill up the imbalance, just to deliver price efficiently to both buyers and sellers. Now, there are two main ways IPDA does this: accumulation and distribution of orders at liquidity pools. They do this by efficiently rebalancing imbalance price action. These are the two ways the market maker delivers price efficiently. And this is what I've been saying. This is just the knowledge you need to have on the chart to analyze your chart, and you are good to go. Once you can understand the offset of buy side and sell side, and you can spot out imbalances in price, and you expect that to be filled up, you can determine your directional bias, because this is where the central banks are going to drive price to, because they basically want to offer price efficiently to both buyers and sellers. If not, the market is basically going to crash. So having this understanding gives you confidence that price is going to go in a certain direction. Now, coming to the chart, this is basically what I mean by accumulation and distribution of orders at liquidity pool. Now, as you can see here on the chart, this is buy side liquidity and this is sell side liquidity. This is buy side liquidity and this is sell side liquidity. This is another buy side liquidity, and so on and so forth. So for price to move efficiently in the market, buy side liquidity, there must be offset of positions here. When market makers are buying, when they are literally buying like this, they are looking for people to sell. When you go to the market to buy something, you understand me, you want to go get things for yourself, you are going to look for willing sellers, people that are going to sell that particular commodity that you are going to look for in the market. You walk straight to those people and they sell that goods for you. That's the same thing. So when the market makers are buying, they are looking for where sellers are in the market, and obviously where would sellers be and where would orders be? It's going to be here. People that were selling here in the market, their stop loss orders are going to be here. So these are willing sellers in the market. The market maker is going to drive price higher and then distribute their price here, and then accumulate more orders here. After distributing their buy orders, they accumulate more sell orders here in the market, and they drive price lower. And now they are selling, right? As they are selling here, they are looking for willing buyers, people that are going to buy their goods from them. Since they are selling, where is that? Sell side liquidity, because there will be buyers here in the market that have their stop loss here. So since they are selling, you will come here, offset price, distribute price here, and then accumulate more long positions, and then they move higher again, doing what? Looking for willing sellers. Where are willing sellers? Here. They come here again, and then they distribute and accumulate, and they do this over and over again. This is how they move price efficiently in the market. This is what IPDA does in the market. IPDA literally creates this liquidity pool in order for them to come and distribute their prices, and this is how they deliver price efficiently, by accumulation and distribution of orders at liquidity pools. Now, efficiently rebalancing imbalance price action. When you see price move like this, now obviously this is a CB, sell side imbalance, buy side inefficiency. Obviously market didn't give chance for buyers to efficiently balance out this price action here, thus they left it open. The way if that does is, after creating this, they come back, engineer sell side liquidity here. Understand this concept. After creating this imbalance in price action, they know they are going to come here to fill this. They know they are going to come here to take back some orders, and then they come here to balance out buy side. Once they are coming up, they create sell side liquidity areas, so that once they balance out price action efficiently here, they drive price lower to clear the liquidity. This is the simple way on how price is being delivered efficiently by IPDA. You understand me? And this is how they offer this in the market. They do this by what we call market efficiency paradigm. This is a market efficiency paradigm, offering of both buy side and sell side in the market, so that the market won't collapse. And we've come to the end of this lecture. Hope I've been able to simplify what IPDA is to you. Do well to view the market in this perspective. Once you can view the market this way, everything becomes simple for you, and you can navigate your way through the market. See you in the next class.